Welcome to the Observatory. Case File 1: The Rise of Private Debt. To the Observatory. This is where we investigate the invisible systems that shape our world. We don't predict markets, we don't sell investments, we ask one question: why did the financial system evolve? Today we open Case File 001, The Rise of Private Debt. Every financial innovation, every crisis, every regulation leaves a trace. Nothing appears by accident. Every drawer in this archive tells the story of an idea that changed the financial system. Today, we begin with one of its fastest-growing chapters. Confidence continued to grow, property development accelerated. New homes, new neighborhoods, and new communities appeared across the landscape. The expansion seemed both natural and unstoppable. Growth is easiest to admire while it still feels perfectly normal. Remarkably simple. Businesses needed capital. Banks provided it. Factories expand. New jobs were created. Entire economies grew through a relationship built on trust.
Banking was once built on relationships. A manager often knew the business, its owners, its employees, and its ambitions. Lending was more than a transaction, it was a long-term partnership.
We've worked together for years. Let's build the next chapter.
Thank you. We'll make it count.
The financial system recovered. Banks continued lending, but after the crisis, every financing decision became more selective. Every new loan required greater confidence and greater resilience. Sometimes the question is no longer can we lend, it's should we. Prosperity has a remarkable ability to silence doubt. Every successful loan encouraged another. Every rising asset price reinforced confidence. The system appeared stronger than ever. But beneath the surface, its foundations were becoming increasingly fragile.
Almost overnight, confidence disappeared. Banks no longer questioned only individual borrowers, they questioned the financial system itself. When trust vanished, credit vanished with it.
I'm sorry, we can't approve new lending, not anymore.
So what happens now? The financial crisis eventually came to an end. Around the world, companies adapted. Factories reopened. Confidence slowly returned.
It's good to see you again, Sarah.
We're ready to expand. Demand is stronger than ever.
Her business had recovered.
The opportunity was real. Everything suggested this loan should be approved.
The numbers were good. The business was healthy. Yet, something had changed. I wish this decision were as straightforward as it once was. Sarah, your company is exactly the kind of business we want to support. But today, I can't approve this loan.
I don't understand.
The answer wasn't inside Sarah's business, it was inside the banking system itself. And to understand that, we need to look behind the decision. After the crisis, banks were required to build stronger safety buffers. The more risk they carried, the more of their own capital they needed. Businesses still wanted to grow. Banks still wanted to lend. But between them, a financing gap had quietly emerged.
But the world's capital had not disappeared. It had simply moved elsewhere. Long-term investors were managing vast pools of capital and they were searching for stable opportunities.
The pieces were already there. Healthy companies, patient investors. The question became remarkably simple. What if we could connect them? The solution became known as direct lending. Investors could provide financing directly to carefully selected businesses. Not through a traditional bank, but through a carefully structured investment.
But someone still had to evaluate each opportunity. Someone to analyze the companies, structure the loans, and protect investors. That's where specialist investment managers came in.
Over time, this approach became organized into professionally managed investment funds. Today, we know them as private debt funds. A private debt fund follows a simple principle. Investors provide capital. Specialists analyze opportunities and manage the loans. Businesses receive the financing they need to invest and grow.
For many long-term investors, the objective is not simply to seek higher returns. It is to build diverse portfolios with reliable sources of long-term income.
Private debt became one way to achieve that. Before a single loan is approved, every business is carefully examined. Its finances, its management, its strategy. Nothing is left to chance. Private debt is rarely a standardized product. Each financing solution is carefully structured to reflect the company's business model, its future plans, and the expectations of long-term investors. The relationship doesn't end when the financing is completed. It begins.
Throughout the life of the investment, the company and the investment manager continue working together, reviewing progress, anticipating challenges, and supporting long-term success. These indicators are starting to drift. Let's review the covenants. Financial covenants are designed to provide early warning.
They help both the lender and the company identify potential issues while there is still time to respond. The best problems are often the ones that never become problems. Unlike private equity, private debt is primarily designed to generate regular contractual income. As borrowers make scheduled interest payments, the fund distributes that income to its investors. For some businesses, private debt offers an additional financing option. Its strength often lies in flexibility, long-term partnership, and financing structured around the needs of the business. Every investment offers opportunities, and every investment involves risk. Careful analysis, diversification, and ongoing monitoring help investment managers make informed decisions throughout the life of the investment. What began as a response to a changing financial landscape has become an important source of financing for many businesses. Today, private debt works alongside traditional banks, helping long-term capital support the real economy. Every financial solution exists for a reason. Understanding how it works helps us better understand the economy itself. Our investigation ends here, but many more are waiting. Until next time, welcome back to the observatory.